Hello, thank you for joining me today. My name is John de Carvalho, and I'm the Chief Investment Officer for Moss Adams Wealth Advisors. And the presentation that I'll be giving today is the 4 most important things that investors need to know for 2016. With that, we'll get into the disclaimers here. One question we often get from our clients and investors is, where are the investment opportunities today? With such a powerful run-up in domestic markets since the financial crisis, it's becoming more challenging to identify investment opportunities. We hope to give you some insight into this by taking a look at valuation. 2 of the areas that we favor in the marketplace right now is the European stock market and the Japanese stock market. This slide shows you what the price-to-earnings ratio is in those areas on a forward-looking basis. As you can see, the blue line on the top is the U.S. market. The dark green line in the middle is the European stock market valuation, and the orange line below is the Japanese stock market valuation. You can see that the U.S. is higher by a decent margin over Europe, and it is much higher than what the price-to-earnings ratio looks like in Japan going forward. Currently in Europe, earnings right now are at an all-time high, earnings growth. In Japan, we're noticing acceleration of earnings growth as well. 2 factors coupled together, one being robust earnings growth, along with lower relative valuations, make these markets attractive to us. If you look at 2015, this may give us a hint to what could continue to persist. The Japanese stock market was up north of 7% in 2015, and the European stock market was right around 7% for the year as well, whereas the U.S. stock market finished flat for the year. The next factor we're going to look at to support our premise is equity risk premiums. An equity risk premium is calculated so that investors get an idea of how much they could gain for taking on the risk of investing in stocks. What's important here is not to understand how the calculation comes about, but just where the numbers are relative to one another. So as you can see in the table above, the U.S. equity risk premium stands slightly below 4%, whereas Europe is north of 6%, all of Asia minus Japan is north of 6%, and the Japanese equity risk premium is closer to 7 at 6.73. The chart below, the red line, is the U.S. equity risk premium. The yellow line is the European equity risk premium. The blue line is Asia ex Japan, and the gray line is Japan. So visually, we can see this, that those equity risk premiums are much higher than the U.S. currently, which means that investors would be better compensated for taking on the risk of investing in those markets versus investing in the U.S. market. I would caution investors to realize that these situations do not play out immediately, nor do they play out over a very short time period. They usually take about 3 years to manifest themselves, and what we've seen in 2015 is an outperformance in Europe and Japan that could be just the beginning of what we see over the next 3 years. The other area of opportunity that we see in the marketplace right now is within senior bank loans. Senior bank loans are those that act like bonds in the sense that you are secured by the collateral of the company issuing it, but the difference between a bond and a senior bank loan is that senior bank loans have floating rate interest paid. That means that as the London interbank overnight rate goes up, these bank loans will reset to a higher rate. Simply put, if interest rates go up, the interest paid on senior bank loans will go up as well. They have 30 to 60-day resets on these, which means that you'll see that rate increase after 30 or 60 days, depending on the terms of each loan. I also mentioned that these bank loans are secured by collateral. The benefit to that is that the collateral that secures these bank loans is first lien senior secured. You are higher on the capital stack for a company than bondholders, equity holders. You are higher than all other claims on property to that company, which means you get paid first if there's ever an issue like a default or a bankruptcy with that company. They're also secured by the highest form of collateral as well. So it's very high quality collateral like accounts receivable. What this means is the payout ratios on a default, meaning if there was a problem with the company being able to make good on their commitment to pay interest, and there is a bankruptcy filing, the payout ratio on that collateral is usually north of 80%, upwards of 85%. That means for every dollar invested, you're going to get 80 to 85 cents back. Roughly speaking, for the bond market as a whole, that's anywhere between 30 to 40%. So for every dollar, if there's a default, you only get 30 to 40 cents of your money back. That said, senior bank loans have a history of being very stable with short bouts of high volatility. The last time we saw that, right here, is depicted on the chart, was in 2007, 2008, where we hit historical highs. What this chart shows is the spread over LIBOR, the London Interbank Overnight Lending Rate. Currently, LIBOR is very low, but what you're seeing here is the spread above LIBOR for these loans, the gray line being the largest corporations, is still right around 400, 500 basis points currently. In the middle market, you've come down since this chart was created to about 600 to 700. So even if LIBOR, for argument's sake, was at 0, you're still getting roughly 4% yield on these bank loans with high quality collateral. So if anybody's concerned about interest rates going up, these may offer a good investment to hedge against those rising interest rates. With that, I'll end my presentation and thank you all for joining me again.